clearly the yield curve is a good indicator of recessionary risk. But, there's so many different ways that you can spin the data. I mean, if you look at the yield curve, let's say between 3 months and 10 years, it's reasonably steep and would tell you that you're not likely to have a recession. The long end of the curve going up is also telling you that right now the economy has a huge inflation problem, not a recession likelihood problem. So there's a lot here to parse before making the assumption that we're going to careen into a recession over the next year.
Steve, you think a recession's on the make here?
I think things are different this time, and I think somebody just threw tomatoes at me when I said that. It's a very interesting situation, Andrew, because if you were coming out of a pandemic, you would say, yeah, things are difficult here. The Fed has to raise rates with high inflation and inflation going higher right now. The trouble is you have the economy coming out of this COVID crisis that we've had, and that engenders a lot of economic growth. You have this very low unemployment rate. So, look, I may be the last guy who thinks it's possible for the Fed to pull off this soft landing, but I do think it's possible if the Fed acts in a steady way, if it can get in front of inflation, that the growth of the economy coming out of COVID could keep it. The other thing, Andrew, is I'm always a little bit skeptical of derived numbers that predict things in the future that are different from if I looked at the economy or the fundamentals. I mean, the 210 spread or whatever spread is a derived number. Nobody actually even arrives at that number. So it has worked in the past, but it has to be negative, and it's a little unclear as to why it works.
Rick, I'm assuming you think there's like a hard landing coming.
No, never make any assumptions, Andrew. I think when we talk about markets, the predictability factors with regard to how they foresee recessions is probably overestimated a bit. And I think in this particular instance, I'll side with Steve Leisman. It's unusual this time. Think about it that normally you hear words like moderate, gradual, with the Fed raising rates. So things like T-bills that are auctioned basically every week, 3- and 6-month bills, they will follow rates up. They don't lead. The coupon curve, 2s, 3s, 5s, 7s, 10s, 30s, of course, term structure, they're building in. So the normal route we look at, whether it's 3 months to 10 years or 10s to 2s, they are not showing us, in my opinion, the right stuff. If you look at 3 months to 2 years, that's where the anomaly is. In other words, T-bills every week are reflecting real-world rates. The 2-year note yield is somewhat out of control, kind of predicting an aggressive Fed. Very unique circumstance. And by the way, the relationship between 3 months to 2 year is critical here because the real research on the yield curve was done 3 months to 10 year. So that distortion, that 3 month to 2 year relationship is as wide. The difference is as large as it's been since 2002. So I think you can kind of throw all that away. But think about the logic there and then think about what Carl Icahn said. T-bills will follow the Fed. And if the Fed is as aggressive as the market in 2s, 3s are showing, then around 2023, you're going to see distortions disappear a bit. And then some of your recessionary indicators in these yield curves will be more realistic.
Hey, Jonathan, react to that, please.
Well, I mean, first of all, there's so many indicators here that the economy looks more early cycle. So job creation is extremely strong, we've seen in recent months. The ISM, which is a great indicator of the industrial economy, is fantastic. The Fed has, the New York Fed, the Cleveland Fed has a recessionary model, and it's actually substantially below average, and it's lower than it was over the summer. Financial conditions, the ability of companies or individuals to make their loan payments or roll over a loan and things like that, is reading that there's almost no stress whatsoever in the system. So, is all this inflation that we're seeing, is it going to eventually cause the Fed to choke this off? And maybe will that cause some recessionary risk? Absolutely. Is it going to happen in 2022? I don't think so. I think the key here, though, is the business cycle is going to be shorter. If we normally would think about an economic cycle is 7 to 10 years. Maybe this one is 4. But we're less than 2 years into this, and it's just too soon to call a recession.
Shepard Smith here. Thanks for watching CNBC on YouTube.